The S&P 500 is pushing higher today after hitting all-time highs last week, even as chances of a March Fed rate, Fed rate cut, I should say, they drop to less than 50%, according to the CME FedWatch tool. So as the debate on when the Fed will cut rates rages on, where can you invest to hedge your bets? To tell us more, we've got here, live in living color in studio, Octavio Marenzi, Opimas CEO. Great to see you in person after, so it's been a while.
It's been a while, indeed.
Indeed. So,
it's
all right.
good to see that you're real people.
You chose the best time, right? We've got all-time highs for the S&P 500. I mean, if you're an investor looking at this market environment right now and have to also kind of pair this with the rate cut probability as of right now, what should be going through your mind? What should be kind of top of the docket for any of your portfolio strategy?
Well, I think all eyes are really on the Fed right now, what they're going to do at not this next rate meeting at the FOMC, but the one that follows on in March. What are they going to do there? And I think the consensus for some time has been now they're going to cut 25 basis points or 50 basis points, and now that's starting to look less and less likely. So that's starting to sort of melt like a snow in the sunshine and basically say, where are we going to go now? What is the Fed going to do? Now, I think if you look at the Fed, and the data that they look at and the markets and where the economy stands and where unemployment stands, you put all those things together, I don't think there's a very strong case for the Fed actually cutting rates at all in March. I think quite the opposite. They're just going to look at it and say, inflation's coming down slowly. It's more stubborn than we'd like. The last core inflation reading was 3.9%. Unemployment is low. The economy is doing well. Markets are at record highs. Why would we cut rates now? Does the market really need another boost from the Fed? It doesn't look like it does. So I think this will embolden the Fed to do nothing. And just wait. And I think we'll see the chances that there's nothing happening go up above 50% as we get closer to the date.
Octavio, how much of that first rate cut, how much does that really matter to the markets here in terms of, has some of that hype been a bit overblown? And then when you put this in perspective, in terms of the pace of cuts, should we be putting a little bit more weight into that rather than the timing of that first rate cut?
I think that's absolutely the right question, is how much are they going to cut over what period? And the Fed tends to, once it starts moving in one direction or the other, either increasing rates or decreasing rates, carry on moving in that direction for an extended period of time. So they tend to move for 12 months, 18 months in the same direction as they adjust their interest rate policy. So you're absolutely right to point out when exactly that starts is not so important, perhaps. But if inflation stays high and if the economy carries on doing really well and employment remains low, I think they'll postpone that further and further out, and we might end up waiting a long time indeed. Now, I don't know when that's going to happen. I wish sometimes that the Fed would share their econometric models with us, since they're a public institution. They could share all their data and their models with us, and they could all figure out for ourselves when they're going to cut rates or increase them.
And then we could be our own dot on the dot plot. Why not?
We could indeed. We could indeed.
And so, I mean, all that considered, there's also the international conflict that a lot of people are trying to figure out. How does that factor into our economy here in the U.S., and will that weigh into the Fed's decision at all?
I don't think that will weigh into the Fed's decision, sort of the geopolitical context right now. I think the U.S. economy is mercifully sort of isolated from that, except from the oil side, so that could be a big impact there. But I think in that kind of sort of geopolitical uncertainty, we've tended to sort of overweight gold a bit and say that looks like a good investment, a good place to be. We did see gold have a nice run up over the course of the past few months since late October as a result of these hopes of interest rate cuts as well, I think, more than anything else. But I think given the geopolitical context, it looks like a good investment again, potentially over the course of the next few months.
Octavio, the results that we've gotten from the S&P 500 companies so far has been a bit disappointing. A lot of that driven by misses that we saw, or downside surprises, I should say, from some of the bank stocks. As you look ahead to the results that we're going to be getting over the coming weeks, are you expecting a bit of a change in terms of that narrative, and what specifically are you looking for?
Well, if we look back at the bank stocks, we had an unusually wide dispersion of the results. Usually all the banks sort of move together and they get very similar results overall. This time around, we saw JP Morgan do fantastically well, Bank of America do okay, Wells Fargo sort of middling, and Citigroup do terribly. And so there was this big spread of results that we usually don't see. What we did see there was net interest margins come down a bit, some tightening. But on the positive side, and I think it's not so much about the bank stocks themselves, but looking at the bank's financials, it tells you a lot about the economy in general. So we saw spending levels were still pretty strong, and credit card expenditures still very, very strong. People spending lots of money. Loan balances very resilient and robust. And also, I think most importantly, default rates on loans remained very, very low. And that was a very important point as well. And that suggests that both the corporate consumer and the retail consumer is doing very, very well indeed and is not at risk of defaulting. So I think that bodes well for earnings coming out and well for the economy overall.
All right, Octavio Marenzi, always great to have you. And thanks so much for joining us here in studio. Always great to get your insight.
Thank you.